Save this video right now. Bookmark it, pin it, screenshot the thumbnail. Do whatever's necessary so that when Monday morning arrives and your screen is red and your gut is twisting and every financial media headline is blaring that silver is imploding and every comment section is overrun with people urging you to dump before it hits zero, you can locate this video within 30 seconds and watch it before you touch a single button on your trading platform. Because the choices you make in the first 15 minutes of witnessing a crash on your screen will determine whether this week grows your wealth or demolishes it. And those choices cannot be made rationally in the heat of the moment. They can only be made now, today, Sunday, while the market is shut and your mind is composed and your amygdala isn't commandeering your prefrontal cortex with fight or flight chemicals that render intelligent decision-making neurologically impossible. This video is your emergency playbook. I constructed it specifically for the scenario where silver opens sharply lower Monday and your gut reaction is to panic. Everything I'm about to present is designed for consumption during a crisis. Brief sections, clear directives, data-grounded perspective. No hype, no false hope, no diamond hands, cult rhetoric, just the mathematical reality of what a Monday silver decline actually signifies within the context of current market structure and what specific responses are rational versus emotional in that moment. Sunday, February 22nd, 2026. Standing rules. I sell nothing. Never have, never will. No programs, no signals, no communities, no mentorship, no fund. If someone invokes this channel's name to request money, they're committing fraud. This is educational content, not financial counsel. I'm not your advisor. Safeguard your capital. Confirm everything independently. Now let me construct your emergency protocol, layer by layer. Layer 1, the first thing you do when you see red Monday morning nothing. You do absolutely nothing for 10 full minutes. Set a timer on your phone. 10 minutes. During those 10 minutes, you do not open your brokerage app. You do not place any orders. You do not check your profit and loss. You do not read any comments. You do not watch any other videos. You do not call your broker. You do nothing except breathe and read the remainder of this section. Here's why those 10 minutes matter neurologically. When you observe a sudden significant loss on your screen, your brain releases cortisol and adrenaline within approximately 3 seconds. These hormones evolve to help you escape physical danger. Flee from the predator, fight the threat, freeze so the danger passes. In financial markets, these identical hormones trigger 3 parallel responses: panic selling, fleeing, revenge trading or doubling down, fighting, and frozen inaction while losses accumulate, freezing. None of these responses are rational. All of them are neurochemical. Research from behavioral finance laboratories at leading universities consistently demonstrates that decisions made within the first 5 minutes of observing a significant portfolio loss produce worse outcomes than decisions made after a 10 to 15 minute pause. The cortisol surge peaks at roughly 3 to 5 minutes following the triggering event and begins subsiding after 8 to 12 minutes. By waiting 10 minutes, you permit your prefrontal cortex, the rational decision-making center, to re-engage after the initial amygdala hijack passes. 10 minutes will not cause you to miss a critical exit. If silver is genuinely collapsing, it will still be lower in 10 minutes. You'll sell at a marginally inferior price. The gap between selling at the 1-minute panic point and the 10-minute rational point is typically under 0.5%. The gap between a panic decision and a rational decision is typically 5 to 15% in outcome quality. The 10-minute pause exchanges 0.5% of price for 5 to 15% of decision quality. That's the most valuable trade you'll execute all week. After 10 minutes, pose these 3 questions to yourself before doing anything. Question 1. Has anything changed about the physical silver market since Friday? Not the paper price, not the figure on your screen, the physical market. Is COMEX registered silver still at approximately 93 to 98 million ounces? Is the Shanghai premium still $10 or above? Are Chinese export controls still active on day 53? Is India still importing silver at 129% above prior year levels? Have London vault stocks been replenished? Has any major new silver mine commenced production overnight? If the answer to every one of those questions is nothing has changed in the physical market, then the decline you're observing is a paper market event occurring within a paper pricing system that has diverged from physical reality by approximately 12 to 40%, depending on which global physical market you reference. A paper market event doesn't alter the physical supply deficit of 270 to 340 million ounces annually. It doesn't conjure silver that doesn't exist. It doesn't reverse Chinese government policy. It doesn't diminish Indian industrial consumption. It changes a number on a screen. That's the extent of it. Question 2. What caused the decline mechanically? Examine the timestamp. Did the decline occur between 6 o'clock p.m. and 7 p.m. Sunday night during the thin Globex window? That's the documented Sunday night suppression protocol. 64% of Sunday nights open lower. Average drawdown when it activates, 0.8 to 1.2%. These moves typically recover by Monday afternoon unless the three-component liquidation cascade was triggered. Did the decline follow a CME margin hike announcement? Check CME's advisory notices. A fifth margin increase would explain the price drop through forced liquidation mechanics, not through any shift in silver's fundamental worth. 4 prior hikes in 8 weeks produced the identical pattern. Price falls on compulsory selling, fundamentals remain unchanged. Price eventually recovers because the selling is mechanical, not fundamental. Did the decline stem from genuine adverse news, a Fed surprise rate increase, a Chinese announcement loosening export controls, a massive COMEX vault deposit of 20 million ounces, a resolution of US-Iran tensions eliminating safe haven demand? These would constitute authentic fundamental changes that modify the thesis. If any occurred, the decline might be justified, and your response should differ from a mechanical paper market event. Mechanical cause? Seasoners paper market manipulation or structural liquidity exploitation. Hold or buy? Fundamental cause. Seirau's thesis inputs have changed. Reassess. Question 3. Is your position sized to survive this? This is the sole question demanding immediate mathematical attention. Not should I sell? Not is silver heading lower? Can your position withstand the current drawdown plus an additional 10% decline without forced liquidation? If yes, you possess the luxury of patience. Paper market crashes unsupported by fundamental shifts tend to recover because the physical demand that propelled prices higher hasn't vanished. It's been temporarily obscured by paper selling. If no, you have a position sizing issue requiring immediate attention. Not by liquidating everything in panic, by trimming to a size that can endure further downside without involuntary liquidation. The objective isn't to abandon your thesis. It's to right-size your position so you survive long enough for the thesis to materialize. Layer 3. Historical context. The media won't provide Monday. When silver declines sharply, financial media follows a predictable script. Silver bubble bursts. Precious metals investors face reality check. Expert warns silver could fall another 30%. These headlines are crafted to maximize engagement during peak emotional vulnerability. They will not supply the following context. You need to possess it before Monday so that when those headlines appear, you already know the data they're purposefully excluding. Context 1. Silver has crashed and rebounded multiple times in this cycle alone. January 30th, 2026. Silver plunged 31% intraday from above $120 to approximately $63.90 in a single session, the steepest single-day decline in modern silver history. Within 5 days, silver rallied 35%, surging back to the mid-80s. Those who panic sold during the January 30th crash cemented losses at the trough. Those who held through the mechanical liquidation or purchased the dip captured a 35% recovery in under a week. That's not distant history. That's 4 weeks ago. Context 2. Every major silver decline in the current cycle has been mechanically driven, not fundamentally driven. The January 30th crash was sparked by a Fed news shock combined with thin liquidity and stop-loss cascades. The structural supply deficit didn't change. Chinese export controls didn't change. Indian demand didn't change. COMEX vault depletion didn't change. London shortage didn't change. Nothing changed except the paper price on a screen in New York. And within a week, the paper price recovered because the fundamental reality reasserted itself. Context. 3. Those who engineer the crashes are frequently the same parties who buy the bottom. CFTC data consistently reveals that during major silver declines, commercial short positions, the bullion banks, reduce their shorts and sometimes pivot to net long at the trough. They orchestrate the crash through margin hikes, phantom volume withdrawal, and coordinated selling in thin markets. Then they accumulate at the suppressed price they manufactured, then price recovers, then they sell into the recovery, then they engineer another crash. The cycle has repeated throughout 2025 and 2026 with documented regularity. If you sell during the crash, you're selling to the parties who caused it, at the price they intended you to sell at. Context 4. Physical premiums typically expand during paper crashes. During the January 30th crash, when COMEX paper silver was printing $63.90, physical silver in Shanghai commanded massive premiums. Physical dealers across Asia reported no change in their asking prices despite the paper price collapse. Buyers seeking actual metal paid $80 to $90 or more while the screen displayed $63.90. The paper crash didn't lower the cost of physical silver. It exposed the chasm between paper fiction and physical reality. If Monday's decline follows this pattern, Shanghai premiums will widen further. Physical dealers will sustain or increase their markups. The paper price will signal crisis, while the physical market remains unmoved, because actual buyers of actual metal understand that COMEX's Sunday night price bears no relation to the genuine cost of acquiring silver in the real world. Layer 4. 5 data points to check before any decision. If you've observed your 10 minutes, answered the 3 questions, and internalized the historical context, you're now prepared to examine actual data. Not headlines, not opinions, not social media comments, data. Data point 1, COMEX registered silver. Retrieve the latest report from CME's website. Is registered silver above or below 95 million ounces? If above 95 million, March delivery pressure is manageable and the paper system has room to maneuver. If below 95 million tons extras, the physical delivery arithmetic is critical, and any paper crash is likely to be brief because physical demand will persist, regardless of the paper price. Data point 2, Shanghai premium. Compare SGE pricing against the current COMEX spot price. If the premium has expanded beyond $12, the physical market is wholly dismissing the paper decline. That widening premium is the single most bullish indicator you can observe during a paper price drop. It means real buyers deploying real capital in the world's largest physical market are declaring your crash is fabricated, and we'll demonstrate it by paying more than ever for actual metal. Data point 3, CME margin. Advisory, determine whether a 5th margin hike has been announced. If yes, the crash is administratively manufactured through forced liquidation. Margin hike crashes are mechanical events with finite duration. Once the compulsory selling depletes itself, the buying vacuum backfills the gap. If no new margin hike, the decline's source lies elsewhere and warrants different analysis. Data point 4, volume and open interest. If Monday's decline occurs on elevated volume, but open interest drops significantly, it's long liquidation. Sellers are being expelled, not voluntarily departing. Forced sellers create temporary price dislocations that correct once the forced selling concludes. If the crash occurs on high volume and open interest grows, new shorts are entering, a distinct and more bearish signal because it reflects genuine, fresh conviction on the sell side. Data point 5, CFTC KOT preview. While the official report publishes Friday, some data services supply estimated positioning updates midweek. If speculative long positioning was already at 11-month lows entering the crash, virtually no longs remain to liquidate. The decline can't sustain because the fuel for further selling, leveraged long positions, has already been consumed through 8 weeks of margin increases. Layer 5, the decision framework. After 10 minutes of composure, 3 questions addressed, historical context absorbed, and 5 data points reviewed, you're equipped to decide. Here's the framework. If the crash is mechanical, driven by the Sunday night protocol, a margin hike, or a stop-loss cascade, and physical market indicators are unchanged or strengthening, Shanghai premium holding or expanding, vault stock still declining, no fundamental shift in supply-demand dynamics, the data-supported response is to maintain existing positions if properly sized, or to contemplate adding exposure at the suppressed price if your financial situation permits and your risk management plan accounts for additional downside. If the crash is fundamental, driven by genuine adverse developments such as Chinese export control reversal, massive vault restocking, Fed surprise hawkish action, or resolution of geopolitical tensions, the data-supported response is to reassess your thesis entirely. Fundamental changes demand fundamental reassessment. Not panic selling, but deliberate reassessment. That means gathering updated data, recalculating your thesis assumptions, and reaching a considered decision based on new information rather than an emotional reaction to the price change. If you cannot determine whether the crash is mechanical or fundamental, because data isn't yet available or causes aren't clear, the data-supported response is to take no action until clarity develops. Ambiguity isn't a justification for selling. It's a justification for waiting. The cost of waiting for clarity is negligible compared to the cost of acting on incomplete information during peak emotional distress. If your position is too large to endure further downside without forced liquidation, regardless of the crash's origin, the data-supported response is to trim to a survivable size immediately, not to zero, to a level where an additional 15 to 20% decline cannot obliterate your account. This is position management, not surrender. You're preserving your capacity to participate in the recovery by ensuring you survive the decline. Layer 6, what to absolutely avoid. Do not sell your entire position at Monday's market open. Market opens during crashes yield the worst executions of the entire day. Market makers inflate spreads, algorithms front-run panic orders. The absolute worst price of any crash day typically falls within the first 30 minutes of the regular session open. If you must sell, employ limit orders, not market orders. Specify the minimum price you'll accept and let the market approach you. Do not add leveraged positions during the crash, hoping to nail the exact bottom. You won't identify the precise bottom. Nobody does. And if you're off by even 2 to 3% with leverage, you could transform a survival situation into a catastrophic one. If you want to buy the dip, use unleveraged positions. Physical metal, unlevered ETF shares, mining stocks purchased with cash, not margin. Do not make permanent decisions based on temporary emotions. Selling physical silver you accumulated over months or years because of a single Monday's paper price action is a permanent decision driven by transient circumstances. The metal doesn't transform because the screen changes. The supply deficit doesn't shift because your brokerage app shows red. Chinese export controls don't reverse because COMEX printed an alarming number at 6 p.m. Sunday. Do not consume comments, forums, or social media during the crash. Every platform will be inundated with people undergoing the same neurochemical stress response you are. Fear is contagious. Panic propagates through social proof. If 500 people in a forum are screaming, "Sell everything," your brain reads that as validation that selling is correct. It's not validation. It's 500 individuals experiencing simultaneous cortisol surges and projecting their fear onto their keyboards. Their fear is not data. Disable notifications. Close the forums. Consult primary sources. CME data, CFTC data, SGE data, vault reports. Not opinions, data. Do not overhaul your long-term strategy based on a single session. If your thesis rests on physical silver shortage, Chinese export controls, Indian demand surge, paper physical divergence, and global vault depletion, ask yourself, did any of those 5 thesis pillars change today? If the answer is no, your strategy shouldn't change either. A strategy is founded on a thesis. A thesis is founded on data. Data doesn't change because the paper price moves for one day. Layer 7, the perspective check. If silver drops to $76 Monday, it will still be up over 200% from its 2022 lows. It will still sit below its inflation-adjusted 1980 high of approximately $200. It will still exist in a market with sub 100 million registered COMEX ounces. It will still confront a 270 to 340 million ounce annual supply deficit. It will still have 60 to 70% of global refined supply restricted by Chinese government policy. It will still enjoy record Indian import demand. It will still have the same industrial consumption growth from solar, EVs, AI, and 5G that existed Friday. A crash to $76 would mean the paper market priced silver even further below its physical transaction value in global markets. Shanghai would be paying an $18 to $20 premium over a $76 COMEX print. That 25% paper physical divergence would be the most extreme in modern history, and the most compelling evidence yet that the paper pricing mechanism is failing. Not that silver is failing, that the mechanism used to price silver is failing. Crashes in a structurally deficient market with depleting vaults and restricted supply are buying opportunities for those with the emotional discipline to recognize them and the position sizing to survive them. They are destruction events for those who sized too large, leveraged too aggressively, didn't plan for adverse scenarios, and allowed cortisol to make their decisions. This video is your plan. Bookmark it. Save it. Return to it when the red screen materializes. Read it before touching any button. Let the 10 minutes elapse. Answer the 3 questions. Check the 5 data points. Apply the framework. Avoid the prohibited actions. Maintain the perspective. Every data source is public. Verify everything. Trust the data. Trust your plan. Trust the 10 minutes.